Welcome. Today we're going to walk through the essential procedures for statutory end-of-year financial reporting. All the information we'll cover is based on materials provided by the Academy of Professional Excellence, designed to help you ensure your financial records are compliant and precise. All right, let's start with the basics. End-of-period procedures. You can think of these as the fundamental checks you need to run to keep your accounting records accurate and perfectly balanced. The core principle here, as the source material makes very clear, is regular reconciliation. It's really all about matching your internal books to external documents, like bank statements. This is absolutely the best way to make sure your financial data has integrity.
So what does that actually look like at the end of every month? Well, it's a methodical process. You're going to reconcile your company files against your source documents, check your bank accounts against the statements, and then verify that your creditor and customer balances are all correct. After that, you'll review the trial balance, take a look at your budgets and cash flow, and of course, pay any payroll taxes that are due.
Now, it's really important to understand the distinction between two different year-end processes. First, you've got the end of financial year, or EOFY. This is about the entire organization's finances, things like inventory counts and making final adjustments to get the main company file ready for the next year. On the other hand, you have the payroll end of financial year, or PEOFY. This is focused entirely on your employees. It involves processing final pays, creating payment summaries, and getting all the necessary tax information over to the ATO.
Let's dig a bit deeper into that payroll component. Getting the end of financial year payroll correct is an absolutely critical part of compliance, and it all comes down to accuracy.
The very first task here is to verify your data. To put it simply, you have to be 100% certain that the figures in your payroll system line up perfectly with the numbers in your company's main accounting record, which is the general ledger.
Okay, so where do you begin? The process always starts by running two key reports that cover the entire financial year. First, you'll need the Payroll Activity Summary, also known as the PAS. Second, you'll need the General Ledger, or GL report, for that exact same period. And this is where you do the comparison. You take the totals for key categories like wages, taxes, and superannuation directly from that Payroll Activity Summary, and you match them, line by line, against the accounts in your General Ledger. If anything is out of alignment, even by a small amount, it must be investigated and corrected. Right. Once every number matches and everything is reconciled, it's time to finalize the process by exporting and archiving your data. This is how you lock in your records for the financial year that's just closed. And let's be clear, this is not an optional step. The source material is very direct about this. Before you officially close out the financial year in your system, you are required to export all the key data. This becomes your permanent official record. So what data do you need to export? The source material provides a specific list. You'll need the main financial statements, your balance sheet and profit and loss report, along with more detailed reports like the general ledger and account transactions. You also need foundational data like your chart of accounts and your list of contacts. It's essentially a complete digital snapshot of the entire year.
Okay, let's change gears now and look at a very specific part of payroll that can often be quite complex: employment termination payments, or ETPs for short.
So what exactly is an ETP? The formal definition is that it's a lump sum payment that an employee receives specifically because their employment has been terminated. Getting this right is all about knowing what to include and what to exclude. Things that are included as part of an ETP are payments for unused sick leave, payments in lieu of notice, and genuine redundancy payments. On the other hand, certain payments must be excluded from the ETP calculation. The big ones here are lump sum payouts for unused annual leave and any superannuation benefits, as they are handled under different tax rules. Finally, let's touch on one last, very important obligation for many employers here in Australia, and that's payroll tax. Payroll tax is a state and territory-based tax that employers assess themselves. The most important thing to remember is that it only applies once an employer's total wages for the year go above a certain threshold amount. So, just to recap, there are three key things to keep in mind. 1. It's up to you, the employer, to assess and pay it. 2. It's a state and territory tax, not a federal one, which means the rules can vary depending on where your business operates. And 3, it's all about that wage threshold. If your total wages are below it, you don't have to pay.
And that brings us to our final takeaway. It's really a question you need to ask yourself. Are your own end-of-year procedures strong enough to guarantee both complete accuracy and full compliance with the law? It's a vital question for any organization. Thank you for your time.